I'm joined by Michael Knott, Managing Director with Green Street Advisors. So, Michael, recently we've seen some sales transactions among the larger healthcare REITs. What were your key takeaways from those deals?
Yeah, so healthcare is obviously an important part of the REIT space, and it's been kind of a quiet year up until just recently. Transactions had been somewhat limited, but just in the last couple weeks, you had an explosion of deals, well over $5 billion of deals across some of the different healthcare property types. And there were a few takeaways, I think. One, it showed that there's a lot of capital available for healthcare, especially foreign capital. There was a couple of foreign new entrants into the healthcare real estate space, so that was an interesting takeaway. And then the companies in particular were able to take care of some tenant concentration issues and improve their coverages along the way. So HCP and Welltower both improved their standing in terms of some of their triple net leases with coverages and concentrations.
And skilled nursing, what's the outlook for changes in that business?
Skilled nursing still faces challenges. There's going to be continued headwinds from a few different areas. One is the ongoing change to different payment models from the government in terms of more toward value-based and bundled payments is a challenge at the top line. And then on the expense side for the operators, they're continuing to face headwinds from expense growth and wage pressures. So all those things are challenging the business, particularly the top line concerns of how the business is going to change. It's going to create winners and losers. The operators are going to have to adapt. So the net of all that noise and all the headwinds, the bottom line is that skilled nursing coverage levels for the landlords, the REITs, are continuing to decline. And you're going to see that for a couple more years probably as there's pressure on length of stay and then the expense pressures. So there's a lot of change, a lot of uncertainty there, but the bottom line is you'll continue to see pressure on the coverage levels that the REITs report, and that has ramifications on portfolio value and how public market investors perceive those companies and those portfolios.
Let's switch gears, talk about senior housing. What's your outlook for operating performance there?
So senior housing is one area where you see a lot of new supply in the healthcare arena. You don't see it in many of the other subsectors. It's not an issue. Within senior housing, it's been an issue in some of the secondary and tertiary markets. More specifically, you've seen Brookdale struggle with some of the new supply in their markets. Fortunately for the REITs, their portfolios in the senior housing RIDEA side, the operating side, are more well protected in top market locations. So unlike some other property types where the new supply, like in apartments, has been in top markets, and senior housing, it's not been that. It's been the opposite. It's been in lesser locations, and so therefore the REIT portfolios on the senior housing side, which have better locations, have been a little better protected. But what you're going to continue to see overall for senior housing over the next couple of years is continued supply. You have about 8% of inventory currently under construction nationwide for assisted living. And so you're going to see those properties deliver. It's going to impact the operating environment. So you're going to continue to see a decelerating trend in cash flow growth for NOI for the senior housing operators. Even though the REITs won't be quite as affected as the national picture, we do expect you'll see either stagnating or maybe slightly declining occupancies, and then potentially some pressure on their pricing power. They've had really good, strong rent growth, so that may moderate a little bit. And so we expect NOI growth to continue to decelerate. And then another big part of all this is that the operating expense part of the picture has been challenging as well with wage pressures.
And REITs seem to be opting to own these senior housing assets in more of an operating wrapper as opposed to going with the triple net format of old. Why is that?
The companies have gone much higher quality in the real estate they own in the RIDEA wrapper because they own 100% of the cash flows of the property. They're not getting the first part of the rent payment of the operating earnings of the operator. So they've gone much more down the quality spectrum, and so the quality metrics are much higher than the legacy triple net portfolios. And I think you'll continue to see both the REITs and the operators prefer that structure going forward, the RIDEA structure. It's a good alignment of interests between owner and manager. Sometimes a manager has a stake in the properties. But I think the bottom line is you'll continue to see the REITs gravitate more toward that structure and more toward the higher quality properties that encompasses because they want to have better quality if they're going to be getting all the ups and downs of the entire cash flow stream.
Well, thank you so much for your time, Michael.
Thank you. Thanks for having me.
And for more on this and other real estate news and analysis, be sure to visit REIT.com.